professional management. Now, as Mr. Stoff has explained, the type of structures where people are involved, purely family run, mix of family plus professionals, and then the professional running the organizations. Now, if the organizations have a full-fledged office abroad, which have got the full-fledged people running and maintaining the structures, I don't think any difficulties would arise. The tax office of any country today would challenge if this is a purely shell structure or a conduit which has no substance absolutely. And therefore, one most important precaution today one would take in creating any structure for holding any investments is through a proper the substance in any instrument or any organization which you create. Now, this issue of which jurisdiction you will use and which you will not use will all depend upon where your business is. It is not, there is no hard and fast rule. Now, India specific, if it is an inbound, people use a particular jurisdiction. If it is outbound, people use another jurisdiction. Now, the question is, if India-centric business it is there, but you have also interest abroad, then you create a structure based on the requirement and then test it appropriately, acceptable to the family, acceptable to everybody, and most importantly, as Mr. Stoff has said, the family document should very clearly envisage and clearly incorporated in the trust document, succession plan properly laid down. Ownership of every family member is fully reflected. Some challenges do arise from the tax perspective as far as India is concerned. Indian tax laws are tuned in a manner that, for example, if you have a charitable or if you have a trust, whether discretionary or specific abroad, to hold your structure. And then Indians generally feel like we don't want to give the management right to a third party. Then the issue arises is if you are in India, if you are a resident Indian and controlling or even without controlling, you are representing as a trustee of that trust abroad, then it becomes, the trust becomes a resident of India, because the definition of the resident as far as non-corporate entity under Section 6 of the Income Tax Act is that any entity other than a company will be regarded as a resident of India if part of the control is situated in India. And what is control? Control is defined, time and tested by the courts. Control will be, in the case of trust, will be the trustees. However, recently a Canadian Supreme Court has taken a very interesting view. The control in the case of a trust is not only the trustees but even the beneficiaries, if the beneficiaries have a right to direct the trustees to do functions in a particular manner. So one has to take care of this particular aspect while documenting or while drafting the trust document. Now therefore, in a case of a company, the rules are very simple. In India, the rule is the company is said to be resident if whole of the control is situated in India. So therefore, if part of the control is situated in India, it is possible to get out of the definition of residence as far as Income Tax Act is concerned. The consequences are, if the company is said to be resident, if though it incorporated outside India, if it becomes a resident, all the directors, sometimes family does not want to get involved anybody outsider, then they have created the problem for themselves. In that event, you have to comply with the law of India. You file the tax return in India and you are subjected to the world taxation in India. So therefore, you have to take, these are minimum precautions which are required to be taken while setting up the organization. So normally we don't recommend anybody setting up partnership from abroad wherein Indian is a partner. Because in such situation, the firm becomes the partner, the resident of India, part of the control is situated in India. Similarly the case with the trust. So in such situation, it is possible to avoid by mixing up the two type of organization, by creating one company and then above the company there will be a trust. Now if you create a trust, better in that situation, don't have any trustee from India. There are some professional managing trustee companies, you can appoint them. But the question arises is again substance. So in such situation, it's a question of, first egg or first hen. So in such situation, in some cases, it is possible for families to create within the family a member to be a non-resident. And if he is a non-resident, he can control the situation. So part of the control still remains with the family, apart from the trustees which are outsider. So in a given situation, based on the needs of the organization, based on the needs of the family, based on the type of the family, size of the family. For example, we were involved in doing some work for a group in Calcutta, large group, which has 5 brothers. The organizations having companies in India, companies abroad, Australia, Austria, Belgium, etc., all the countries. manufacturing setup, banks, everything is owned by them. Now the issue arises is they want to have the control situated outside India, but at the same time not to be seen to be having driven from India. The family, part of the family is out of India, so therefore it is possible to structure the organization in a manner you get rid of the Indian tax laws. If you are doing business in India, you are going to pay the tax in India. That is 100% sure. Paying tax up to a particular level is cannot be avoided. But beyond that, saving is very important. And how do you save? There the art comes in, and you must do it systematically. And that has to be planned properly. And again, as I said, the world is changing. It is a dynamic world now. Hitherto, what used to happen, people used to, they never used to consult the accountants, solicitors, lawyers. A banker would go and say that, okay, you set up a company in BVI, you set up a company in Cayman Island, and people without even knowing the other family members set up the companies and corporations and set up the bank accounts abroad. The world today has shrunk. There are countries and countries which have come together to sign exchange of information. It is an Indian agenda, driven agenda, that these countries should come together to sign automatic exchange of information. Now, by 2017, the world will create a platform of exchanging the information with each other automatically. You don't have to then, the moment the transaction takes place from one country to another country, both the authorities will get, this transaction will get triggered to the authorities of both the countries, tax authorities. So therefore, there will be a room of inquiry. Now, there are some countries, my experience is very interesting in this aspect. Some countries were very rigid in doing the assessments, very carefully scrutiny every item of the banking transaction, debit, credit, very detailed, minutely, like our Indian experience. Indian officer, if he makes an assessment, I guarantee you, you can stand to any test of inquiry world over. There is no problem on that. But there are countries and countries where my experience is they look at your accounts, out of that accounts, only related information about your income and expenses they will take into account. Banking, they don't bother at all. And people manipulate all those banking systems in a manner that they don't give any information to the tax authorities. But this, I believe, will be not a story for the future. It is only the past scenario. So therefore, in such scenario, keeping in mind the exchange of information which is taking place, keeping in mind what is developing in the OECD world, what is known as the BEPS, base erosion and profit shifting. And the OECD is now driving the world mad. By 2015 December, they will create host of the document, host of the pattern, changes in the laws, recommendation to the changes in the treaties, digital world, how it should behave, transfer pricing, how it should take place in the world. As such, they are driving mad the world, and they are going to make further life difficult. So therefore, keeping in mind this, one has to visit his structure time and again and keep it in tune with what is happening today. This is what my sense of advice on this.
I just got an idea for a financial thriller, but we'll talk about it later. Tarek, you are the expert on the trust chicken and trust egg. So there was a discussion earlier, but by some experts in the earlier panels where they talked about trust for special purposes, whether it's a specially abled child or any other objective. Now, when you're doing a succession planning for a family office, are there certain things one has to keep in mind, and what should be the approach, things that people are learning?
When you primarily talk to people for succession planning by itself is a very sensitive topic. I mean, walking up to somebody and telling him that you may have a dispute within your children, walking up to somebody and saying that your son may go through a divorce, you need to do this particular kind of planning to protect the wealth. At the same time saying that everybody knows we are all perishable commodities, but going and highlighting it to somebody on his face that you will die one day, so it's time for you to look at succession. Those topics by itself are sensitive. Entering into another space where the client or the individual is any which way hurt that he's got a special child or a God's gift, and going and emphasizing him to do something for him, that's again a very sensitive space where you need to deal with. You need to look at many factors when you talk to a client for something like this. Primarily, when there are two children in a family, they may fight among themselves. They may have some kind of a dispute, but they're both capable of managing the affair. But on the other side, when you have one parent or one child who is mentally not stable and the parents are not sure if the other sibling will take care of that particular children after the parents are there or not. So clients are very concerned about those kind of issues. There are quite a few things that they have started moving towards. I mean, trust is one of the most important factors when it comes to planning for special needs. There are few factors that you need to keep in mind, and one very important thing is that you need to have a buy-in from other family members, because end of the day, even if you appoint a corporate trustee, you will need someone from the family to be a guardian for that particular child. Even for the parents by themselves, if the child is above 18, he or she needs to apply for a guardianship legally, because you lose out the guardianship rights after the child turns 18. So there are factors like these. Again, when you're looking at passing on wealth, you know that the wealth may not be able to be used completely by the end user because he or she is not mentally stable. At the same time, how will that wealth grow? You need to have the right financial advisors to get the wealth growing, to be able to use for the benefit of the child. It's going to be an expensive relationship to maintain the upbringing of the child, for the medical care, for the right treatment, for the right hospitals, right doctors. All of that needs to be taken care of, where the importance of identifying a right set of trustee also comes in. Does the trustee have the bandwidth only to manage finance, or does the trustee have the bandwidth to do all the other activities that it really needs? Does he have the right affiliation or tie-ups in place with the right hospitals, with the right treatment, right doctors? Do they have some panelists on board who can understand the illness of the particular child? So there are multiple factors that one will have to look at, and then just a general succession plan.
Right, thanks Tariq. Let's do a little test. Let's see whether the audience they were sleeping, checking their phones, or were they listening to us. Are there some questions which you would like to ask the panel? Not me. The hand that went up was not for a question. Okay, there's one question. Lovely, lovely. Can we have the mic there? More and more questions are welcome. When you form a trust overseas, don't you trigger off a suspicion automatically?
Ajay, that is a question. If you are setting up a trust overseas, and if you have family members abroad, and they are setting up a trust for your benefit, it should not trigger any automatic suspicion. But if you create huge wealth over a short period of time, very short period of time, in that such a trust which you have created, that should create suspicion. It is that all of a sudden, how did you make such a big wealth? And if that is not fully explainable, then the issue arises. In such situation, possibly you can use number of multiple other options of, instead of creating direct wealth over a short period, there are other options one can look at it.
Property, etc. Like property, maybe. Yeah. Okay. The other thing is that if you don't have a family member overseas, then would trust be still an option for succession planning?
Then if you do not have a family member abroad, the trust within India itself is an option available for succession planning.
Oh.
There is nothing you require to create a trust abroad which will really be beneficial to you, because your whole business is in India, and if your assets are in India, you can hold the assets through a trust as well. And at times it is beneficial, at times it is not workable. It is not necessary that in all the circumstances it is advantageous or it is a more efficient route to hold the assets abroad. However, in case of a situation like big corporations, big companies, and if they have got so many subsidiaries, ultimately, eventually, if the family wants to hold all this group through a particular, all the entities are held through a particular organization, there the trust could be a very efficient route of not only holding the companies, but even the family succession planning. It's very efficiently doable.
I think his question was offshore assets but no non-resident family member. Maybe that was, but the answer is yes, you can create a trust, but then you'll have to sort of work with a professional trustee to manage that trust, and you will have to probably settle the initial corpus for establishing the trust. You will need some help over there, either through potentially an LRS remittance or just for the initial corpus. So it all depends on how what is the nature of the wealth, how it got there, who's going to set up the trust and who is going to manage it as trustee. But if it is purely onshore wealth and all family members are over here, offshore trust makes no sense at all.
More questions? Oh, there's one. Maybe you can start speaking. I'll relay it.
Between the trustee and the beneficiary, is that a scenario which does happen quite often, or is it a figment of imagination?
Can you repeat, please?
Trustee and beneficiary.
Conflict of interest.
Conflict of interest. He thinks that it's almost inevitable. Am I correct?
So what you are saying is that you are a trustee as well as you are a beneficiary.
No.
No, between the trustee and the beneficiary.
Let's say, for example, a trust is constituted.
Yeah.
There's a person who's a beneficiary and set of trustees are different,
Yes.
as is the usual practice.
So if the trustees are independent of the beneficiaries,
Right.
they will be guided by the trust instrument.
Uh-huh.
And where is the conflict of interest in such situation?
Because the trustee will say that I have a leeway over allocating the assets or the way things have to be run or something like that. It might
But
not
I think
be
the-
a
I'll take
conflict
that.
of interest.
Yeah, I think your question is correct. Is there inherently a conflict between trustee and beneficiary? Yes. It's the beneficiary's asset and is held legally by someone else. And there is lot of case law and precedent of when trustees and beneficiaries get into a fight, and then the trustees usually would, the beneficiary would typically approach a court and get the trustee removed. There's another interesting instrument that is used not so often in India, but very common overseas, called the protector. So he is a person or an agency or a company which is established at the stage when the trust is established itself, who is usually given the power to remove the trustee in certain circumstances. And certain decisions are also of the trustee are made subject to the approval of the protector. So there are a number of ways in which you deal with it, but fundamentally, yes, is the nature of the relationship between trustee and beneficiary ridden with conflict.